Today, the experiment continues. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post, our Property Imperative Weekly Update, covering the latest finance and property news with a distinctively Australian flavour. And as I said yesterday, this will be a short post today, taking account of the fact that we're just running up to Christmas, and also, of course, the flow of news is on the slide. But there are a number of important things to talk about. I guess the most important event this week was APRA's removal of the 30% speed limit relating to interest-only loans. Now, we don't think this is going to have a significant impact on the market because there are tighter underwriting standards already in place. And indeed, Fitch Ratings came out with a similar view, essentially saying that the tighter underwriting standards are already in place in terms of income and expenditure analysis. And of course, APRA is going to do some further analysis next year in terms of loan affordability and underwriting standards. So their conclusion, which I concur with, is that this will have very little impact on the momentum in the market. And as we discussed yesterday, the latest auction clearance rates were also significantly down, again signalling slower home price growth into next year. So turning to the markets, we already covered the Australian dimensions in our post yesterday, so this is just a quick look at what happened overnight in the US. The Dow Jones Industrial Average fell a further 1.81% to 22,445, and that's a new 52-week low. The S&P 500 fell 2.14% to 2,415, and the S&P 100 fell 2.38% to 1,071. So all the markets are down. The tech-heavy Nasdaq fell considerably, down 2.99% to 6,333, and is now firmly in bear territory, having dropped more than 20% from its high of August the 29th. And in fact, the Nasdaq is the first of the three major US stock indices to cross the threshold, and that drop was less than 4 months. And I guess that's probably a leading indicator of what we can expect from some of the other markets going forward. Essentially, the Nasdaq's fall reflects a sharp move by investors away from the market leaders, things like Facebook. And so not surprising, we see Apple down 3.89% to 150.73, Alphabet or Google down 3.16% to 991, Amazon down 5.71% to 1,377, and Facebook down 6.33% to 124.95, way down from earlier in the year. And it's worth reflecting also that the bull market for the Nasdaq, which reached its high on August the 29th, it had gained 539% from its post-financial crisis low on March the 9th, 2009, including reinvested dividends. And it's delivered a total return of more than 611% in that time. By contrast, in the same period, the S&P 500 gained just 331% with a total return of 425%. So even with the drop since late August, the Nasdaq is nearly 400% above its March 2009 low, with a total return of more than 456%. The S&P Financials Index dropped 1.94% to 379.45, and we see the sector sliding. Goldman Sachs was one of the worst performers, down 4.96% to 160.05. The overall volatility index rose 6.1% to 30.11 and is certainly now in extended risk territory. Looking at the bonds, the 10-year price dropped 0.28% to 278, while the 3-month fell 0.46% to 238. And it's worth just reflecting that if you compare the short term and the long term, the possible yield curve inversion has not yet occurred. Gold was down 0.73% to 1,258, and the Bitcoin fell 1.93% to 3,950, indicating continued volatility in this part of the market. And the crude oil futures, the WTI, fell another 1.05% to 45.40, continuing its drift lower due to extended supply. It's worth noting, of course, that at these sorts of levels, some of the shale oil producers in the US will have difficulty making any returns, and they may throttle back their supply. So it will be interesting to see whether that actually adjusts down the track. The US dollar index was up 0.76% to 97.01. If you stand back and think about this, the QE unwinding, which the Federal Reserve is now in, not only lifting interest rates but also reducing buybacks, means that we are in relatively uncharted territory. And of course, the impact on stocks and the broader market will be quite significant. But of course, it's also quite difficult to untangle this from the immediate issues around, for example, the shutdown, which looks as though it's going to happen thanks to Trump's initiatives with regard to the war. And we also need to question the extent to which US corporates are able to continue to pay at these high interest rates ahead. And so to bring that into sharp contrast, here is the BBSW data up to date. And you can see a considerable spike in funding costs up to 29.76 basis points. And at these levels, many of the Australian banks are going to find that their international funding costs are going to be tough to deal with. There is margin compression, therefore, and that's going to put more pressure on them to lift rates or cut rates on deposits. So the critical point to make is that this whole quantitative easing experiment, which effectively was to try and support the economy after the global financial crisis, has now led to unnecessary unwinding of that, essentially lifting interest rates and removing the buyback processes. But that's going to have a downward impact on asset prices, particularly stocks, and a spillover effect into the broader housing market as well. So this is uncharted territory. This is an experiment that we're in the middle of. And frankly, it's probably one of the biggest experiments ever made on a global basis. So we are really in uncharted territory. And just before I go, let me highlight some recent posts. There was a post that Joe Wilkes and I put up recently relating to the Auckland housing sector. Pretty concerning. That was the first in a series of posts, a bit of a showcase, if you like, of what we're going to discuss over the next couple of weeks. There's a post that John Adams and I put up with regard to the APRA announcement and the RBA announcement with regard to the housing market. And if you're looking for more content over the extended Christmas break, then you can always go back to our live stream from last Tuesday, an hour and a half of questions and answers on all things relating to finance and property in Australia and beyond. And so finally, let me just say that if you want more information in the meantime, you can always go to the Digital Finance Analytics blog at www.digitalfinanceanalytics.com. There you'll find more information. You can subscribe there as well to get even more research alerts and a whole bunch of other information that we put up. Just a quick reminder, if you'd like to support our work, you can always do that via the PayPal facility. Here's a link for that. Or to subscribe via Patreon, where you can also get access to some exclusive content. And if you like what you've seen here today, please share the post, like it, add a comment or question. We do read them all. Meantime, we hope you all have a restful break, and we will be back with more posts, a little bit less frequently perhaps over the next few days, just to keep the wolf from the door. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and we'll see you next time.